We got a question on YouTube concerning tax loss harvesting that asks, why does it only work with significant capital invested? In your example, you reduced your taxable income by $10 and your portfolio is worth 10 plus on paper. Is that not a better situation than before?
I gave that example of the $10 for just simplicity. The reason why it only really works with portfolios that are larger is because actively managed tax loss harvesting portfolios have minimums. So no manager over a tax loss harvesting portfolio is going to take on an investment of 10 grand. It's just not worth it for them when it comes to the billing. So they'll only take large amounts of money, which typically have to be $1 million or more. That might be frustrating, but just keep in mind, like, they have to actively find losses to accumulate to offset other capital gains in the future, or even currently in the present year. So again, the only way around that is you try to do it yourself, which, I mean, you'd have to be actively involved and find ways to mitigate your tax bill by finding stocks that are dipping that you hold and sell them. And who's to say they won't dip further or that you miss out on other capital gains? So it's really tricky. I would say that tax loss harvesting is great, but most of the time it's not worth your time until you are someone that has at least $1 million or more in assets that could be managed. So this could be something great for someone that is in real estate, but also has a nest egg of $1 million or more in assets that could be managed, specifically in tax loss harvesting strategies that can accumulate tax loss capital gain or capital losses. And then let's say they want to sell a property and they know that capital gain that they're going to get from that property that they've been depreciating over time, it's better in that scenario. So I wouldn't say it's like a size that fits everybody, but it can be a very powerful strategy when it comes to accumulating assets and selling those assets at the right time when you have a tax loss harvesting portfolio. Again, the only way really around that is if you were to try to actively manage your own portfolio, which is possible, but 9 times out of 10, it's just not worth your time. There's other things out there that are better.